We are still in the first part of our presentation in week 1, devoted to understanding the margin analysis of the company. This is the 4th video of week 1. After having covered the evolution in sales in the video 2 and the structure of the margins in the video 3, we concluded on the need of being a little bit more sophisticated in analyzing the past and future trend of these margins, which lead us to the so-called scissor effect and the break-even analysis. What is the scissor effect? The scissor effect happens when the costs are growing at a faster rate than the revenues, leading first to a squeeze in the margins and then a loss situation as shown in the graph. This raises some crucial questions on the strategic position of the firm, its relation, its bargaining power vis-à-vis its suppliers of raw material and spare parts, vis-à-vis its customers, and its distribution system in general, vis-à-vis its employees, etc., etc. 4 situations occur in practice. Situation 1. A sudden increase in costs. For example, the increase in the oil price when the barrel in the last 10 years went from $20 to more than $100, while in the short term, prices could not be increased. After some time, due to the competitive position of the companies, because there was no real alternative for the customers or strong growth in the demand, the increase in cost could be transmitted to the customers, leading to a significant increase in revenues. This has been more or less the case of the airline industry. Situation 2. After a period of high growth, the rate of growth slows down or even stops, while the costs continue due to some inertia of most of them to grow, leading to a negative margin. We find many examples of such a situation in some new companies, in new technology, facing a slowing down of their growth after a few years of explosive development due to change in taste of the market, the emergence of new competitors, or a dramatic switch in technology. Situation 3. Declining revenues while costs remain constant or decrease at a much lower rate. Examples are numerous in some mature companies facing increased competition from emerging markets. The need for restructuring appears very quickly as crucial and vital for these companies. Situation 4. The positive scissor effect, the one that everybody would like to experience. Company with a strong position in the marketplace, enjoying some economies of scales, would be perfect example of this beneficial state. Let's illustrate this effect with our case, Gremlin. We have seen in the previous video that sales have been growing in the last 2 years at a rate of roughly 50% per year, while the operating profit, the EBIT, has only, if I can say so, grown by 50% over a 2-year period. Many companies would be more than happy to have such a growth in their EBIT. But in the case of Gremlin, as expenses are increasing faster than revenues, we have a perfect illustration of the scissor effect. We already reviewed in a previous video the main reason for such an increase in cost. Video games are becoming more and more sophisticated, require more work, more development time. The expectations of the customers are higher and higher. Marketing and selling costs are becoming more and more important. They are skyrocketing as the company goes from a local and regional location to become a global and an international company. The Exhibit 1 of the case is also providing some strong explanation. The company has good products, but selling 295,000 units of a product is very small compared with some of the players in this industry, which sells millions of units of some of their key products. Gremlin has no star product and has therefore a very limited bargaining power vis-à-vis its customers, that is the giant companies of the distribution, Tesco, Walmart, Carrefour. Gremlin is not in a situation to impose its condition in terms of pricing to its distribution network. It looks like a Mini traveling alongside huge, strong trucks. Another explanation of Gremlin's problem may be generated from a sound break-even analysis, which we are going to study together in the 5th and final video of this first week. So, see you in a few minutes.